Welcome back to a discussion of the Monetary Policy Committee minutes that have just been revealed or announced on the Reserve Bank website. I am speaking to the external members of the MPC, Dr. Shashanka, Bhide, Ashima Goyal and Jayanth Varma. Gentlemen, Ashima, thank you very much for waiting on. Before I come to what I thought were very hawkish comments from Dr. Patra, Dr. Varma, I just wanted this one point from you. Because you are arguing that we have to go to 6 and pause, and we are almost at 590 now, do you not think that that will delay the reach to 4%? After all, your mandate is 4%.
See, the MPC has a dual mandate.
Yes.
Inflation and growth.
Yes.
And it has nothing else. Okay? No current account.
Yes. Yes.
So now, when we talk about inflation having been a problem for 3 years, let us remember that growth has been a problem for even longer.
Okay.
We have had unacceptably low levels of growth for longer than we have had unacceptably high inflation.
Yes.
And we should not take the eye off the ball on growth either. So the question is that you have unsatisfactory inflation, growth, and unacceptably high inflation. Where do you draw the balance between the two, and where do you steer the economy within this conflicting pulse and pressures? And what 6% does is to raise the real rate to around 1%, which would take it to most probably above the neutral rate. So at this point, we are focusing more on bringing inflation down than on supporting growth. A real rate of 1% is more anti-inflation than it is pro-growth. So a longer festering growth problem is being deprioritized in favor of inflation. That is what the MPC is doing at 6%. And to go more than that, to go rate significantly more than that, unless if we see that our action so far has been inadequate and we have no evidence of that. To go beyond that would be to jettison the second prong of our mandate. It would be to say we don't care for growth at all.
Okay.
See, bringing inflation down to 4% is important. Restoring growth is also important.
Fair enough.
So the balance depends on which side is the problem worse.
Okay. Okay. Fair point, sir. Actually, Dr. Bhide's arguments also are very much echoing this, as is Ashima's. Ashima, I now want to read out to you what sound like extremely worried statements about inflation from Dr. Patra. He says that, of course, there are those transient elements in terms of geopolitics and energy prices. And now I'm quoting him. What is disquieting, however, is that inflation, stripped of these transitory effects, has become unyielding and tightly range-bound around the upper tolerance band of the inflation target. The Reserve Bank's forward-looking survey suggests that selling prices in manufacturing and services may rise further as pass-through from input cost pressures remain incomplete. Exchange rate volatility is amplifying these core price pressures, especially in view of key import prices being invoiced in US dollar, which obviously has appreciated. And further, I think this is very important. Inflation expectations are rising, with signs that they are becoming unanchored over a 1 year ahead horizon. Dr. Bhide is also pointing to this 1 year ahead inflation becoming higher compared to the previous survey. And now again, I'm quoting Dr. Patra, taken together with the closing of the output gap, rising capacity utilization in manufacturing, surging demand for services, and the pickup in spending as the festival season nears, monetary policy must move to red alert, as hawkish as it gets. Ashima Goyal, you want to comment on this? He's really worried about inflation.
I think much of Michael Patra's commentary is about US and US inflation.
No, this one is on India, ma'am. This one is on India.
India, a major factor. He is saying firms will raise prices, but they have not. We've had even consumer non-durables actually cutting prices, like palm oil, soaps, and so on. Firms are not, because they're realizing that demand is slowing. They can't pass on prices, and they have restructured and reduced costs. And the most important factor that I see causes second-round effects that happened in the early 2010s and 11 was high wage growth. We don't see that at all. Right? So the second round effects are not there. We are just at an inflection point where those supply side pressures are easing, the global supply side shocks. Finally, earlier Michael Patra was very dovish. He was one of those who felt that it's temporary supply
Yes,
side.
that's why I read out, because it
Now
clearly seemed.
he's switched to the other. I think moderation and being watchful is much more helpful.
Okay,
They really very upset.
No, I take it seriously that he seems to have changed his tone, and that's why I, kept that quote in front of you. Well, actually, I don't have enough time to get the same comments from others, because I want to spend the last few minutes on your thoughts on financial stability. I know it is not an MPC mandate right now, but I separately want to ask all three of you this question. Dr. Bhide, you go first, sir. Financial instability. I mean, look at the way pension funds have been running helter-skelter in the UK. Would you worry that this can be contagious? Separate from your mandate, sir.
No, obviously, financial stability is core of policy. And I guess not just monetary policy, I think, but the financial stability is important, I think. So I don't know, from the perspective of the MPC, I'm sure that one constituent of the strategies that are required for macroeconomic stability is low rates of inflation. So in that sense, I think we should worry about financial stability, and I think the inflation targeting and targeting at a relatively low rate. I mean that is important. So
Yeah.
that's all.
I buy that point. You all have argued it admirably. I'm not taking away. I'm just worrying whether the manner in which there is, today Janet Yellen complained of illiquidity in the US Treasury market. I mean, you wouldn't have, expected that kind of a statement from a market which we thought is large and liquid. Dr. Varma, just your thoughts, again, not as an MPC member, but as a seasoned watcher of financial markets. Is this something that can become contagious and become destabilizing?
See, financial instability is usually a product of excessively low rates sustained for excessively long. I do not think that the low rates in India lasted long enough for that problem to come in. In some other countries of the world, it has lasted too long. In India, I think we had excessively low rates for about 6 months to a year, from mid-21 to early 22.
Yes.
That is not really long enough to build up excessively large bubbles. We probably had a mild bit of asset price inflation, but not really enough to blow very large bubbles that could become stability threatening. That is my view, that it wasn't long enough for that to happen. Yes, some of it came from the bubble being blown by global central banks.
Yes.
But that was also not long enough and severe enough to create a financial instability issue. It is enough to create a lot of pain for a lot of people, which is fine. People should know that these markets are volatile, that they can go up and they can go down. So they will suffer pain, but not enough pain, in my view, to destabilize the financial system.
No, actually, even the governor points out that our balance sheets are extremely healthy at this point in time. No, I'm not worried about financial instability of any bank or, corporate in India or any excessive FX exposures. But more generally, instability in global debt markets. Do you see them having spillover effects on India? That's my question. Ashima, your final thoughts.
I think we are at a very good point in India because we went through 10 years of really tightening and cleaning up the financial sector.
Yes.
And we have very low leverage. And I think we've learned the lesson that too tight liquidity and too high interest rates, as well as too low, both create instability. So we are moving towards sort of a moderate policy where liquidity will be in surplus, but not too much. And rates will be moderate, not higher than 1% real rates. So I think all that makes for, we have reserves, etc. So all that makes for, we have fiscal monetary coordination, good targeted fiscal support for those who need it without too much of a rise in fiscal deficit. So all that gives us the space for policy to smooth external shocks.
Yes.
And this is very, very important.
Yes. Yes, you make that very clear in your minutes. Thank you very much, Dr. Varma, Ashima and Dr. Bhide. we have to wrap up because we are out of time. We wrap up on this edition of the RBI MPC Minutes and their analysis. Thank you very much for watching this special show.